Hey, it's Wayne from truthaboutmortgagerates.com here with the update from the mortgage market. Over the past few days, we've pretty much seen rates stay somewhere in the same range. We've seen them get better, we've seen them get worse, come back and get better, and then get worse again today. Now, since last week, we've pretty much stayed in the same spot. Today, we saw a huge run up in stocks. It started off the day, stocks were down 300, bonds were trying to make a move forward, but then through the day, stocks really took off, and by the end, up almost 600 points. Almost a 900-point swing in one day. That's a huge swing. But these days, volatility is the name of the game, and frankly, if you don't have big swings in a day, you're kind of bored. So in the end, we saw stocks run up, bonds selling off. Money has to flow into stocks, and it's flowing out of something, again, it's flowing out of bonds, driving rates up. And what we look at going forward is we've broken through some support levels, and we may see rates moving up here in the short term and before we see another turnaround. It's going to be key to see how the overseas markets react to the run up today and how our stock market opens up in the morning. Now, we may get new economic data over the next few days that can start to change the sentiment in the market, but there's been so much bad data coming out, the market's almost used to it. They're almost baked in so much bad data. When we have bad data, just as this morning, we saw new unemployment claims up over 500,000 for the week. Huge number. And then we saw continuing claims to the highest level in over 25 years. Now, this is huge, huge information when you're talking about where the economy is heading. People continue to be out of work, they can't find new work when they've been on unemployment for a while. That only means that the economy is going to go slower and slower. Now, that's bad for the economy in general and all the people out there, but hopefully it should be a good thing for mortgage bonds and overall long-term interest rates. Because what that's going to translate to is it's going to slower economy, lower inflation. Long-term bonds like low inflation. Frankly, I think we're going to be talking over the next few months about deflation. And I think that's really going to scare the market. And once they hear people talking about that, the deflation talk is going to drive long-term rates down. We do have some other issues about supply coming into the market that are going to keep rates higher. But I think overall, I think the deflation scare is going to drive long-term rates even lower. Now, that's going to set up everybody out there to be able to save some money on their mortgage, assuming that they still have decent credit and have the equity to work with in their home. So looking forward, opportunity for you to save money, and the way the economy is going, you're going to need to be saving as much as you can. So check out our report, truthaboutmortgagerates.com. Check out the link over there and find out really what goes into it so you can start understanding. So when it comes time for you to take advantage of interest rates, you're going to know more than the person you're talking to on the phone, or at least know, does that person have any clue of what they're talking about. Check it out. And this is Wayne from truthaboutmortgagerates.com. Until next time, see you later.